Waking up to a surprise tariff announcement sends immediate shockwaves through the market, often triggering a cascade of stop losses before you can even log in. Reacting to individual geopolitical headlines is a high-speed path to losing capital. By the time an alert hits your phone, institutional algorithms have already moved the price. We are running a stress test on a standard, vulnerable Forex portfolio to expose its hidden flaws and map the specific adjustments needed to fix them. Survival heading into 2026 requires an account mathematically structured to withstand geopolitical shocks, regardless of what the news says. This hypothetical trader setup is a classic glass cannon. It shows dangerous overconcentration in export-heavy pairs like AUD-USD and CAD-USD. Tariffs physically disrupt supply chains, instantly lowering global demand for raw materials and the currencies of the nations that export them. Swapping out these highly correlated, vulnerable pairs for safe haven currencies helps the portfolio absorb market panic. Pairing a vulnerable currency with a resilient one, like trading AUD-JPY, creates an automatic buffer. While trade tensions hurt the Aussie, the yen's stable government and massive trade surplus provide a counterbalancing strength. Moving beyond currency into asset class diversification, specifically gold, provides a final layer of defense against fears of slowing global growth. Building resilience means actively reducing correlation risk, so a single localized trade dispute cannot wipe out the entire account. The second vulnerability involves holding naked long positions, leaving a trader completely exposed to sudden spikes in US dollar volatility. The market sentiment channel moves faster than the actual economy. Institutions often dump risk-sensitive assets the moment a tariff is mentioned, long before any real data changes. Basic Forex hedging functions as mandatory trade insurance for these open positions. A correlated hedge limits exposure. By opening a small short position on USD CHF, the gains on that short partially offset the losses on a long USD CAD trade if the dollar suddenly drops. These hedges are designed to strictly limit downside damage during unpredictable market swings, rather than maximize profit. The third vulnerability is trading based on price action alone, while remaining blind to the macroeconomic shifts driving those moves. Trade balance reports and manufacturing PMIs serve as the primary early warning systems for tariff-related instability. Disruptions in specific domestic industries provide leading indicators for currency weakness long before a central bank has the chance to intervene. Integrating geopolitical intelligence and an economic calendar into daily prep allows traders to anticipate volatility instead of simply reacting to it. Using tight stop losses and standard position sizing can destroy even a perfectly diversified portfolio during a trade war. Tariff-driven markets move in erratic gaps and spikes that easily knock out tightly placed defensive stops. Placing stop losses wider allows a trade to survive the expanded volatility without getting clipped prematurely. Widening a stop loss requires an immediate reduction in lot size. To maintain the same monetary risk, a doubled stop loss distance demands a 50% cut in position size. When geopolitical fear spikes, capital preservation and leverage reduction take priority over aggressive gains. Returning to our initial scenario, this stress-tested portfolio now absorbs the market shock of a tariff announcement without triggering catastrophic losses. The result is a transformation from a fragile, reactive account into a hedged, diversified machine positioned for resilient growth. Leverage the advanced charting tools and economic calendars at FXNX to build your own trade war-proof portfolio on NX1 today.